Picture this. March 12th, 2020. You're watching your brokerage account refresh on your phone, sitting on the floor of your kitchen because your legs actually gave out. The S&P just opened down 9.5%. Your 401k, the one you've been feeding for 11 years, lost $40,000 in the time it took you to make coffee. You're watching the number drop in real time. You sell. Everyone around you sells. In the next 72 hours, retail investors pulled $208 billion out of the market. The single largest panic liquidation event in recorded history. This is the silent divergence. When markets bleed, retail investors see destruction. The 1% see a fire sale. Look at 2008. Look at the dot-com crash. Look at the inflation spike of 2022. The script always plays out exactly the same way. The middle class gets wiped out, and the apex predators of the financial world end up owning a larger piece of the board. Here is the reality that Wall Street hopes you never figure out. The wealthy do not survive crises by holding cash. They survive and thrive by moving their capital into 5 specific asset fortresses. By the end of this video, you will know exactly what those 5 assets are and how you can position your money right next to theirs before the next panic hits. There is a protocol. It is not taught in business school. It is not discussed on CNBC. It does not appear in the personal finance content your algorithm serves you, but it has executed with near-perfect precision in every major financial crisis of the last 100 years. Economists have a sterile name for it: counter-cyclical capital deployment. The people who run it have a simpler name. They call it Tuesday. Here is how it works. A crisis hits. It does not matter whether it is a pandemic, a bank collapse, a war, or a sovereign debt spiral. What matters is the psychological response it triggers in the majority of people: fear, urgency, the biological need to stop the bleeding. Retail investors, small business owners, and the middle class begin liquidating. They sell their equities. They pull cash from funds. They park money in savings accounts earning 0.5% while inflation runs at 8%. They feel responsible. They feel like they are finally being smart, and on the other side of every single one of those trades sits an institution. During the 2008 financial crisis, JP Morgan acquired Bear Stearns for $2 a share, a firm that had been trading above $170 just 12 months earlier. During the COVID crash of 2020, private equity firms deployed over $1.5 trillion in dry powder, the term used for capital held specifically to strike during moments of public panic. In 2022, as retail investors pulled a net $300 billion from the equity market in response to rising rates, institutional buyers quietly accumulated dividend-paying infrastructure assets, agricultural land, and private credit at generational discounts. This is not a coincidence. It is architecture. The wealth transfer protocol depends entirely on the emotional predictability of the retail investor. It needs you to panic. It needs you to sell. It needs you to believe that holding cash is conservative when, in an inflationary environment, cash is simply a slower form of loss. The 5 assets in this video are what get bought on the other side of your fear. Pay attention. The first asset is real estate, but not the kind you're thinking about. Forget the single-family rental. Forget the REIT you found on Reddit. The wealth class does not buy property the way you buy property. They use the asset itself as a weapon, and the weapon is debt. Here is the mechanism. A billionaire-backed fund acquires a Class A commercial tower or a luxury multifamily complex at a suppressed valuation during a market dislocation. They finance it with long-term, fixed-rate debt, typically at 60 to 70% loan-to-value. This is not recklessness. It is precision. The debt is a shield. In an inflationary environment, fixed debt becomes cheaper in real terms every single year, while the asset's value and rental income both rise. They are literally getting paid to borrow. During the 2020 to 2022 cycle, Blackstone's real estate arm, BREIT, grew to over $125 billion in assets, accumulating rental housing, logistics facilities, and data center properties, while retail sentiment around commercial real estate was at a multi-decade low. They bought the fear. The debt shield protected them from short-term volatility, while inflation worked in their favour on every outstanding loan. The retail version of this strategy is a 30-year mortgage on a primary residence, which is not an investment vehicle. It is a shelter with a payment schedule. The institutional version is a portfolio of cash-flowing properties where tenants service the debt. Appreciation builds equity, and depreciation offsets taxable income. Trophy real estate, the kind with irreplaceable locations, strong tenant demand and pricing power, does not just survive economic turbulence, it compounds through it. What the 1% understand is that in a world of currency debasement, hard assets with leverage are one of the most efficient wealth-building machines ever constructed. The debt gets inflated away, the asset holds its value, the cash flow continues, and the tax code, written largely by people who own exactly these kinds of assets, rewards every step of the process. The first moat is built with borrowed money, and it is nearly impossible to cross from the outside. The second asset never appears in a retail investor's portfolio. You will not find it on Robinhood. You will not find it in a standard brokerage account. That is not an accident. Private equity is deliberately structured to exclude the majority of the investing public, and the returns reflect exactly who has access. Here is the performance reality. Over the last 2 decades, private equity has outperformed public equity markets by an average of 3 to 5 percentage points annually, according to data from Cambridge Associates. The S&P 500 returned approximately 10% annually over the same period. A 3 to 5 point differential, compounded over 20 years, is not a rounding error. It is a generational wealth gap. But the return differential is only part of the story. The deeper structural advantage is control. When a private equity firm acquires a business, they are not buying a minority stake in a publicly traded company, subject to quarterly earnings pressure and shareholder sentiment. They are buying operational control. They install their own management. They restructure the cost base. They identify adjacent acquisitions, use debt strategically to amplify returns, and exit on their own timeline, not the market's timeline. This is asymmetric control. The outcome is not subject to a vote. It is engineered. Apollo Global Management, KKR, and Carlyle collectively manage over $2 trillion in assets. Their flagship funds are closed to anyone without $5 million in liquid net worth or accredited investor status. The structures are deliberate. Long lock-up periods of 7 to 10 years mean these vehicles are inaccessible to anyone who might need their capital back during a crisis, which is exactly the point. The illiquidity is a feature, not a flaw. It forces a long time horizon and eliminates the emotional selling that destroys retail returns. The accredited investor threshold in the United States, set at $1 million in net worth or $200,000 in annual income, currently excludes approximately 89% of the population from accessing these vehicles entirely. The rules of the game were written before most people were invited to play. Gold has never gone to zero. That is not a slogan. It is a 5,000-year empirical data set. And while retail investors debate whether to allocate 5% of their portfolio to a gold ETF, the institutional world uses hard assets in a structurally different way, both as a crisis hedge and as a store of value that operates completely outside the financial system. Central banks globally added over 1,037 tons of gold to their reserves in 2023, the second highest annual total ever recorded according to the World Gold Council. China, Poland, Singapore, and India were the largest buyers. These are not retail investors chasing a trend. These are sovereign treasuries making long-duration decisions about what holds value when paper instruments fail. But gold is only one layer. The deeper moat is in the asset class that most people never consider: fine art, rare collectibles, and alternative stores of value. The global art market generated over $65 billion in sales in 2023, with the ultra-high net worth segment driving the majority of transactions. Art does not correlate to equity markets. It does not pay dividends or generate cash flow. What it does is hold value across generational time horizons, qualify for favourable estate planning treatment, and provide portfolio diversification that no financial instrument can replicate. The May Moses Art Index, which tracks repeat sales of major artworks, has shown average annual returns of 7 to 9% over multi-decade periods. Blue-chip artists, the names that appear in major auction houses and permanent collections, have appreciated through every recession, market crash, and inflationary cycle of the past century. The hard assets moat works because it sits entirely outside the monetary system. When the dollar loses purchasing power, gold reprices in dollars. When equities fall, art does not follow. When banks fail, physical assets do not evaporate. This is not alternative investing. For the ultra-wealthy, this is the foundation layer, the bedrock beneath every other position in the portfolio. Every time you pay a toll, a utility bill, an airport departure fee, or a water bill, there is a reasonable probability that a private infrastructure fund is collecting a percentage of that payment. You just never see it. That invisibility is precisely what makes infrastructure one of the most powerful wealth-building assets in the institutional playbook. The defining characteristic of infrastructure as an asset class is its monopoly structure. A toll road does not compete with another toll road. A water treatment facility does not face a disruptive startup. A natural gas pipeline network, an airport landing system, a port facility. These are assets with legally protected or geographically enforced exclusivity. The demand is not cyclical. It is embedded in daily life, and the pricing is typically indexed to inflation, meaning the revenue grows automatically as currency loses purchasing power. Brookfield Infrastructure Partners, one of the largest infrastructure investors in the world, manages over $100 billion in assets across toll roads, railroads, pipelines, data transmission towers, and port operations across 5 continents. Their annualized distribution growth has averaged approximately 9% over the last decade. That is not equity market speculation. That is a toll booth, operating 24 hours a day in perpetuity. The institutional entry into infrastructure accelerated significantly after 2008, when sovereign wealth funds and pension managers began rotating out of public equities and into long-duration real assets. The Abu Dhabi Investment Authority, the Canada Pension Plan, and the Norwegian Government Pension Fund collectively deploy hundreds of billions into infrastructure positions that retail investors cannot access directly. What makes this asset class particularly powerful during inflationary periods is the combination of pricing power and essential demand. People do not stop using electricity when rates rise. They do not stop using water. They do not stop shipping goods through ports. The cash flows are not just stable, they are contractually protected. The wealthy do not just own the businesses that serve the economy, they own the pipes, the roads, and the towers that the entire economy runs through. In 2021, Bill Gates became the largest private owner of farmland in the United States, holding approximately 270,000 acres across multiple states. This was not a philanthropic gesture. It was a capital allocation decision made by one of the most analytically rigorous investors alive, and it followed a pattern that family offices and institutional managers had been quietly executing for over a decade. Farmland is not glamorous. It does not generate the kind of headline returns that attract retail attention. What it generates is something more valuable in an inflationary environment: essential, non-corruptible yield. People eat regardless of what the Federal Reserve does with interest rates. Agricultural demand does not contract during recessions. Food is not a discretionary purchase. The NCREIF Farmland Index, which tracks investment returns on US agricultural land, has delivered average annual returns of approximately 11% over the last 30 years, with notably low volatility compared to equity markets. In years where equity markets posted significant losses, farmland frequently posted positive returns. The correlation to traditional financial markets is structurally low because the underlying demand driver, human caloric need, is not financial. The asset also benefits from scarcity mechanics that no other investment class replicates. There is a finite amount of arable land on Earth. It cannot be manufactured, 3D printed, or digitally replicated. As the global population grows and climate disruption reduces cultivable acreage in certain regions, the supply-demand dynamic for high-quality agricultural land becomes structurally more favourable over time. Institutional investors, including TIAA, Nuveen, and multiple sovereign wealth funds have allocated tens of billions to farmland over the last 15 years. The investment thesis is simple. It produces cash flow through leases and crop revenue. It appreciates with land values and inflation. It provides genuine portfolio diversification, and it will never become obsolete. The 1% are not buying farmland because it is exciting. They are buying it because in a world of manufactured financial complexity, they still want to own the thing that feeds the world. Now, here is what the retail investor actually does, and this chapter is uncomfortable, because if you are honest with yourself, you have done at least one of these things. The first retail trap is the savings account. The average high-yield savings account in the United States currently offers between 4.5% and 5% annual interest, which sounds reasonable until you compare it to real inflation. When you include shelter costs, food prices, and services inflation in the actual spending basket of a middle-class household, the real rate of return on cash savings is near zero or slightly negative. You're not building wealth. You're maintaining the illusion of it while your purchasing power slowly erodes. The second trap is the target date retirement fund. These products, the 2040 fund and the 2050 fund, are the default option in the majority of 401k plans in America. Over $3 trillion is currently parked in them. They are broadly diversified, which sounds prudent, and they are heavily weighted toward public equities and bonds, which means they are maximally exposed to exactly the assets institutional investors reduce during periods of monetary stress. Diversification across public markets is not the same as diversification across asset classes. It just feels like it is. The third trap is the inverse relationship between media volume and good decision-making. The louder the financial news becomes, the more retail investors move. Studies from Dalbar's annual quantitative analysis of investor behavior have consistently shown that the average equity fund investor underperforms the S&P 500 by 1.5 to 3 percentage points annually, not because they picked bad funds, but because they moved in and out of them at precisely the wrong moments. The news cycle is not a signal. It is noise designed to generate engagement, and every emotional trade it triggers is a transaction that benefits someone on the other side. The wealth gap is not just a product of who has more capital. It is a product of which has better behavioral infrastructure. The trap is not the product. It is the reaction. The smart money does not hide. It files paperwork. And if you know where to look, the institutional playbook is available to anyone willing to read a SEC form instead of a financial headline. 13F filings are quarterly disclosures required of any institutional investment manager with over $100 million in assets under management. Every 90 days, firms like Bridgewater Associates, Citadel, Tiger Global, and thousands of others are legally required to disclose their equity holdings to the public. These filings are free, they are searchable, and they are almost entirely ignored by retail investors. Sites like Whale Wisdom, Dataroma, and the SEC's own Edgar database aggregate this data in readable formats. The lag is 45 days, but the directional intelligence it provides on where large capital is rotating is more valuable than any analyst recommendation. Beyond 13F filings, Form 4 disclosures reveal insider buying and selling activity at the executive and board level of public companies. When a CEO buys $10 million of their own stock on the open market, that is not a gesture, that is a bet with personal capital. Academic research has consistently shown that insider buying clusters, where multiple executives at the same company purchase shares within a short window, historically precede significant outperformance. Private market signals are harder to read but not invisible. Real estate investment patterns show up in commercial property transaction databases. Agricultural land purchases are recorded in county deed filings. Infrastructure fundraisers are announced in institutional press releases that receive no mainstream media coverage. The behavioral edge is not about finding secret information. It is about ignoring the information that is designed to make you react emotionally and replacing it with the information that shows you what large long-horizon capital is actually doing. Those are two completely different data streams. One is optimized for clicks, the other is optimized for returns. The discipline is learning to live entirely in the second one. You now have the architecture. The only question left is what you do with it. The execution plan does not require you to be wealthy to start. It requires you to stop thinking like a retail investor and start thinking like a capital allocator. Those are different identities, and the shift begins with a single portfolio audit. Pull up every account you hold, every fund, every savings vehicle, every position. Ask one question about each of them. Does this asset have pricing power during inflation, or does it erode? If it erodes, that is not automatically a reason to sell. It is a reason to understand the risk you're actually carrying. The next step is reallocation, not revolution. You do not need to liquidate everything and buy a farmland REIT tomorrow. What you need is a deliberate staged increase in your exposure to real assets, private market vehicles where accessible, inflation index cash flows, and stores of value that exist outside the public market system. Platforms like Fundrise, Yield Street, and Acre Trader have created partial entry points into real estate, private credit, and farmland for investors at lower minimums than traditional institutional access requires. They are not identical to institutional vehicles, but they move in the right direction. The third step is behavioral. Set a rule that you will not make a portfolio change within 48 hours of a major financial news event. That single protocol, if followed consistently, will eliminate the majority of the performance-destroying decisions that the Dalbar data documents year after year. The 1% are not smarter than you, they are not harder working than you. What they have is a framework that does not bend under emotional pressure, access to assets that insulate them from the volatility they know is coming, and the patience to let time and compounding do the work that panic constantly interrupts. The wealth transfer protocol runs on your fear. The moment you stop supplying it, you stop being a participant in the losing side of that trade. The playbook is in your hands now. The only remaining variable is whether you use it. If this gave you a framework you've never seen in mainstream financial media, the single most important thing you can do right now is share it with one person who is still playing by the old rules. Not because it helps this channel, but because the wealth transfer protocol works best when the people closest to you are still on the wrong side of it. Break that cycle. Subscribe if you want the next layer of the institutional playbook. The next video covers exactly how the ultra-wealthy use tax architecture to legally compound returns that retail investors will never see because they never knew to ask.